Hey everyone, welcome back to Brazil Crypto Report, podcast produced by Activo Media and Advisory. I'm your host, Aaron Stanley, and today I'm joined by David Taylor, who's co-founder of Etherfuse, which is doing some very exciting work in the realm of tokenized sovereign debt, non-USD stablecoins. Before we dive into that, I want to give a quick shout out to our show sponsor, which is Avenia, which is building seamless infrastructure for cross-border payments in the Americas, and we'll be hearing more about them later in the show. David, it's great to have you here.
Thank you for having me. I appreciate it. I know we've been brushing shoulders in similar circles, so glad to be a part of this and super grateful for the community you're building. I've been part of the Telegram group for quite some time.
Amazing. Yeah. And yeah, we feel like we've been running into each other at various stablecoin conferences this year, but finally getting a chance to kind of solidify this. But maybe to get started, maybe give us the quick elevator pitch of like, what is Etherfuse? What are you guys building?
Etherfuse aims to be the SDK or APIs or asset issuer of all sovereign debt around the world on chain. And the way we do that is we issue an interest-bearing stablecoin denominated in that currency on chain and manage the regulatory process, the security, and the collateralization of those assets with short-term treasuries of that corresponding asset around the world for you. So sovereign debt, a huge primitive, a huge, I would say, prerequisite to a lot of finance. And we want to issue that on chain for builders to work with. And they don't have to do what we do. They can just move, get started. So that is fundamentally Etherfuse.
Amazing. Yeah, so the ultimate RWA, right? Government bond.
Yeah,
right?
Exactly. The most boring asset, but in some sense, the most critical asset to even start with. Like everything is compared to the risk-free rate. So if you want to build a different product, you kind of need the risk-free rate to compare your product to. And on the blockchain, that just hasn't really existed, So we have a lot of super speculative assets and not really a place to store safely our assets in the short term.
Yeah, well, in a way, the risk-free rate has always kind of been Bitcoin, right? Like you're measuring your returns against Bitcoin, and obviously Bitcoin, tends to vary in price significantly depending on the part of the cycle we're in. But yeah, I'm really excited to dive into this. Maybe to get started here, we'd just love for you to give us kind of your personal background. You've got a pretty interesting journey, and we just love, like where did you come from? Like what's your kind of career experience, and how did you end up getting into this world of blockchain and tokenization?
My background has been cryptography and computer science in, I would say, the traditional world. I had, worked at a few startups, in Arizona, which we just call those companies, not necessarily the fancy startup world. Then at Boeing, I did PKI infrastructure. So anything that ran on the airplane or any data that was loaded or unloaded, we kind of wrote the infrastructure to securely sign those and run them and monitor that nothing we didn't want could run on the airplane. After that, I went to Apple and I did the similar, field of work at Apple, added into some network security. So manage the APIs that the company uses to interact with crypto, to sign certificates, to manage network security. And at the time it was growing like every year the size of Nike. So it was a huge undertaking to keep things safe while managing, huge growth. After Apple, I wanted to go back to school. I wanted to start a company, and I didn't really think I had the network or know how to start a company. So my idea was go back to school. If I could do it now, I'd probably do it differently, but school enabled me to learn that there was an easier way. When I was at school, though, I met a good friend of mine. His name's Isaac Saldana. And his company at the time was called SendGrid, and they IPO'd while we were at school together. And so I went to a business program, and he and I were the only actual engineers at the same business program. So we became friends super quick. And after his company IPO'd, it was purchased by Twilio for, I think, $3 billion. And so he was super liquid. Yeah, I know. It's a dream opportunity of go back to school. Everyone says school's, arguably a waste of time. But for me, it was a good opportunity.
I'd like to take a moment to tell you about our show sponsor, Avenia. If you're building a wallet, a crypto consumer app, or a global payment platform, Avenia is your bridge to Latin America. You can instantly connect to PIX, SPAY, and CBU using stablecoins with a single API. No banks, no FX desks, no SWIFT. Head over to avenia.io to learn about how you can move money globally with full compliance and real-time settlement. Now back to the show.
Everyone says school's, arguably a waste of time, but for me, it was a good opportunity. And he said, hey, I want to start a startup studio, which is, basically like an incubator that invests deeper into a startup and launches companies out. He said, will you come be the CTO? I said, heck yes. So I quit Apple, moved down by him to Southern California, and we launched a few companies together. The one most relevant for Etherfuse was this company called NeuroPayments, and it was a payment solution in the US. And this was like 5 years ago, or actually 7 years ago. So this is when crypto was like still kind of new. It was after the ICO season. And when we were doing P2P payments in the US, it was like we were building like down to the guts of moving money from the Federal Reserve. And it just became very obvious that this is broken and there's no way in a sophisticated way to fix it. And so at the time, Solana came out and it was just quick and it was relatively fast and relatively secure. And I think we were just so deep in this thing that just seeing a balance go from one account to the next in under a second and extrapolating the growth of crypto over the next 10 years, we felt like this is it. This is going to fix a lot of things. But it was still super old. I'd say not. It was still super young. It wasn't obvious to everyone at the time. So this is like 4 years ago. But I said, look, I believe this is going to be something that's going to solve this problem we're trying to solve in a unique way. And it was very clear to us that the barrier between like an investment vehicle like the bond or the risk-free rate and using that in a service that could do payments was near impossible in TradFi. So, but on the blockchain, it seemed possible. Now, 4 years ago, the US, where we were, was anti-crypto, not like today where they're trying to push things, but it was not only not pro-crypto, it was anti-crypto. So when we had the idea, hey, let's issue a bond on chain, we think it's a security. Let's not pretend it's not. Let's just say it's a security. What do we do? And we looked around in the US and just thought, this isn't the right place to do this. The incentives aren't here. Adoption for payments and systems and access is relatively is actually like available in the West. And so at the time we hypothesized like, okay, if we're going to build a product that's going to bring value, let's go to the place where the highest amount of value to be brought is. And so what country are all the incentives there such that if we go and approach regulators in that country, we'll have the most compelling evidence that this is going to be beneficial for them. And so at the time, we came up with this formula of remittances, cost of credit, financial access, and pretty much those things. And that gave us a number, right? And so each country we sorted by the highest number to the smallest. And the list was like China, India, Mexico, Brazil, but in the top 20, there was a lot of Latin America. And so we thought about China and said, what are the chances that China is going to let two Americans come in and build a bond on chain? So we thought about 10 seconds and said, that's not happening, And then we thought about India because India was also pretty high up there. And India is pretty defensive too. India has this if you're familiar with the space, they have an India first, which is, not a bad thing. But if you start a company like an Uber over there, they'll fund a competitor under you to keep it local, which is, not against it, but I didn't think that we would be as successful there. Then we started to really look into Mexico, and, Mexicans and people from the United States, they're actually pretty close culturally. I know, the world may kind of like pretend it's not, but actually, we are pretty close. So we thought, hey, I think we have a chance in Mexico to be able to issue a security on chain that has some, benefit for the country. And so almost, naively, we just like literally went to Mexico. Two gringos went to Mexico and said like, hey dude, how could we issue an asset on chain? And we found somebody who said, hey, I know a good lawyer who does this stuff, met with a lawyer, and we literally just started. So we approached Mexico through this law called the FinTech law. And we said, hey, we believe that we should put bonds on chain. And we believe that if we do it, it's a security. What do we need to do that legally? And after 2 years of back and forth, Mexico replied, we understand what you're trying to do. We don't think what you're trying to do constitutes a security under Mexican law, which was like the most wild outcome we could have expected, At that time, everyone was trying to pretend like, hey, nothing's a security, like, don't worry about it.
Yeah, like we're a utility token, right?
Yeah.
We're not a security.
It's artwork. It's a collectible. Like everyone was saying everything, but we were like, we want to put bonds on chain. We want to put like literally sovereign debt on chain. We didn't see how it wasn't a security. And so we basically approached them. They responded and we appealed twice saying, we're pretty sure it's a security, and the whole process was to get like a definitive argument in the future after we do this that, hey, we've tried our best and you've articulated, why. And so we had enough information to legally build a product. Well, the final outcome is a 300-page document from the SEC. It's called the CNBV of Mexico, saying why our protocol is not a security. And that was fantastic because that's enough for us to say, hey, like what else could we do, And so from that, we started to issue sovereign debt on chain. And our first product was a Mexican product called CETES. That's just, that's the acronym for Mexican treasuries. And we issued it on chain. And since then, we've been adding more and more assets. And I think the main reason why we're talking is we also have a Brazilian product, the Tesoro, that we issue, which is Brazilian LTNs, fixed rate LTNs that we issue on chain. So it's a yield bearing Brazilian stable bond, which is what we call it. And so that's like the history of Etherfuse up until the point of deployment.
Got it. And maybe let's kind of dive into like the mechanics of the stable bonds and then also the stable coins that you're issuing sort of in conjunction with these. Like what's sort of like the interplay? What's the relationship? What are you steering users into the coin or when a user buys one of these, are they buying the stable coin or are they buying like a piece of the tokenized bond or like how does all that exactly work?
So I would say fundamentally what we want to do is we just want to issue what we call stable bonds on chain. And we want people to do stuff with that. So we think this is like a primitive for everything. So if you want to on-ramp a country to the blockchain, they have to have their debt represented on chain. Now, since we're so early, we're having to show people like what you can do with our products. So, which was surprising because we first issued these and then it's like, it was like, okay, what now what, And so we've had to like go out and build things to show people what you can do. And so you're mentioning stablecoins, you're likely referencing our MXNE, which is our Mexican stablecoin. We call it a sovereign coin just for the delineation. That means nothing other than it's an asset that is 100% collateralized with our stable bonds. And so the reason we even did that was we wanted to demonstrate that any of our assets can be used as collateral to issue a stable coin and that you should do that. So, and if you do that, 2 to 3 people can issue a stable coin meaningfully and focus on distribution and adoption instead of like the hard, annoying, almost impossible work of regulating the collateral. So we do have a stablecoin, a Mexican stablecoin, but really what we did with that was to show like you can build a stablecoin using our product, this primitive. We've also built lending markets. We've built, I'd say, leverage trading strategies. And we don't actually want to do that as a company, but we felt we've seen that we've had to show people what you can do. And our Mexican stablecoin, it's the fastest growing Mexican stablecoin in the world. And it was almost like something we didn't want to do. We want other people to do it. So it's kind of ironic, but now we have it and it's great. So that's the difference is we were just showing like, hey, you can build like our Tesoro, hypothetically someone in Dubai could build a Real using our Tesoro product and it would be functionally equivalent to any stablecoin issued out of Brazil.
Got it. So I could basically build my own stable coin. I could be anybody in the world. I could build my own Real pegged stable coin and just use your tokenized these Tesoro bonds that you've tokenized. I could use these as collateral for my stable coin to ensure like 100% one-to-one backing, basically.
Yep. And the hardest part about a stablecoin is, okay, is the contract audited? Do I have, I would say, regulated entities holding these? So in Brazil, B3 is a big bank down there. They hold all our LTNs. We have third-party auditors go through and verify all our accounts to ensure that for every asset on chain that there's an attestation. We have all of the workflows to send reals to collateral to back to USDC. So that's kind of a complicated process. And so when you issue a stablecoin, you generally need like a huge team, even just lawyers. But if you wanted to, like our Mexican MXNE, it's issued out of the United States, which is not something you could do before in TradFi. You couldn't have a pesos-like equivalent without some sort of interaction, but you can today with Stablebonds.
Maybe let's take a step back a bit and talk about what are some of the tangible like benefits to tokenizing public debt like this, and like maybe what are, I mean, I know there's questions of like access, like who can buy these things, right? These aren't products that are generally very available to like people who are not qualified accredited investors. And then I also think like a lot of people, especially maybe in crypto, maybe don't realize that like the yields on some of these things are actually quite high. Like Brazil, like the benchmark rate is, or risk-free rate is, it's something like 15%, right? And I think Mexico is quite high as well. So maybe talk a bit about like, why, like what are the benefits of bringing these things on chain? Like was this unlocked that maybe couldn't have been unlocked in kind of the analog finance world before?
So the first primary benefit is just access and distribution. So you're right. Like I think maybe I don't know these numbers for Brazil very well, but in the US or Mexico, under 2% of the population owns sovereign debt directly, where they hold fiat, which is given their functionally equivalent or the ease of access is the same, you should hold less fiat and more debt because you earn something for that. The second is if I can expose this interface to the world, people can do stuff with that. And there's a benefit. So in the real world, if I build a service and the risk-free rate is unavailable to me, I have to charge a fee for that service. And in the real world, any fee I charge needs to earn me more than it would if I just invest in bonds. Because otherwise, why go through all the effort, just take my money, invest in bonds instead of offering a service. So what that means is the user engaging with that service is paying more than the rate of a bond to use that service. So it's costing me more than it would. This gets a little complicated to understand, but the fee of a bond that the government pays is going to be lower than the fee of a service that the private industry charges. And so what's interesting by that is if I can provide a service that uses the risk-free rate as a revenue stream on chain, I've created a service that can't be competed with in the real world. So I've enabled something for people to use that creates a better product than the traditional world because it will always be cheaper. So, and that gets a little confusing when I explain it, but I've created a revenue stream to build products with that will outcompete the real world. And so by issuing sovereign debt on chain, I've made that possible for developers, for people, for users to build something on chain that's better than the real world and the real world cannot compete with. That's the second. The third is there's a lot of, this is like a primitive for a lot of things. For savings accounts, you can build them with sovereign debt. For lending markets, for hedging products, you can use sovereign debt to do that. For leverage trading, like our Tesoro right now, It's looped, and on Solana, it's earning like 36% yields, which is crazy. Leverage is a lot of risk, by the way. So, it's not necessarily something I'm saying is the best idea, but it is a good idea. People do it. That's all very trivial now that those products exist on chain. So bringing things that are hard to work with, like your common person, if they're sending money across borders, they can't hedge that foreign currency while they send it in case there's a weak gap and the currency fluctuates. They don't have that ability. Being able to like engage in a hedged product as a user is near impossible. You have to be an institution, but a general user can do that on chain now very simply. So we've just really enabled what I would say this primitive to on-ramp a country on chain by issuing their assets on chain, by issuing their sovereign debt on chain.
Well, I love this because I mean it's such a tangible, like just like real world application of the technology, right? Like this is an incredible bridge between kind of this crypto world that we live in and it's fun to play around in, and then the real world that's still sort of pretty much segregated right from the rest of crypto. But this is like a really like powerful use case illustrating like the benefits at the national level of like at the country nation state level of like what this can do, and then also like the ability to create like new business models that are just like head and shoulders better than what like the pre-blockchain world can offer, right? And I think that's kind of like the holy grail that people have been searching for the last 10 years with blockchain products. It's like okay, like sure, you can send money with this thing, or you can crowdfund, you can fund your ICO with it, like, but what are like some use cases that like you can't like this, like the blockchain can like 100% do this like better than in the real world, right? And so we're starting to like hone in on some of these things here.
Like to that point, I think the blockchain makes bonds better. So bonds, are assets. They're tokens that increase in value because the collateral is just being reinvested into compounding at that rate. Well, today people don't use bonds as currency because they're not like as fungible. They're not easily sent, permissionless from one wallet to the next. But our assets are. So our assets have all the utility of fiat or a stable coin, but they're an interest-bearing bond. So the blockchain quite literally makes sovereign debt better than it can be in the traditional space.
So it's unlocking all this utility to the bond that like you just can't have in any other context. Whether it can be used as a payment mechanism, it can be used in some of these kind of DeFi protocols. It can be used for like lending, or you can borrow against it, et cetera, very easily. It becomes much more liquid. There's much more, presumably, there's there's always a question of whenever countries are issuing new debt, it's like, well, who's going to buy this debt, right? Like, well, this presumably opens up access to like more people who can buy your debt, so you can continue printing money, and spending, right, as a country. So this is super interesting, and I guess I would love to maybe touch a bit on kind of the distribution strategy for who's ultimately like kind of the end user of some of these. I guess both just like buying these tokenized bonds, but also maybe using some of these other types of products and services that are being kind of gradually layered on top of this.
So distribution strategy is interesting. I think the end outcome, to the limit, it's everybody. But for us to distribute these assets, I think the primary place is in decentralized ecosystems. So like, a counter or a contrary, like a point to say what we're not trying to do is we're not necessarily trying to go to centralized exchanges and list these assets, because I think that's a less optimal strategy. Really, what we like to do is engage with like an institution, deploy those assets on a blockchain so everyone has access to them. So, for example, if you're a market maker and you want to facilitate an FX from the dollar to the Tesoro that can be off-ramped to Brazil, you can actually make a lot of money that way. You not only have like the risk-free rate as you LP that asset, but now you have transaction fees and a spread that you can earn. And so our main approach right now is to talk with those people who have wallets or who have some distribution channel and use that. Another example is like there's this huge problem in FX today where people have to go in and out of the dollar, even though the dollar is irrelevant to that trade. So if I want to send money from Mexico to Brazil, today I go from Mexican, MXN to the dollar to the real, which is kind of insane. Even with stable coins, I have to FX into USDC, which has a cost, and I have to FX out of USDC or USDT into the real, which also has a cost. With our assets, you can go from MXN. So, CETES, our Mexican product, you can go straight from any bank account to CETES on chain to any self custody wallet, and there's zero fees. It's the 1,000 pesos equals $1,000, 1,000 pesos worth of CETES. Then you can go to some marketplace, FX into the Tesoro, and off ramp into the real. So we have eliminated, in best case, a whole like 50% of the FX that you engage with by eliminating the need to interop with the dollar.
Wait, so you basically figured out a workaround to this entire kind of stablecoin sandwich model that a lot of these other folks are doing, right? Because a lot of the stablecoin sandwich is basically just recreating what you just described. We're like, okay, I'm going to go from Mexico peso into USDC and then into Brazilian real, and the stablecoin sandwich just kind of makes that like one atomic transaction. So maybe it's it's less work and maybe it's slightly cheaper because it's only one transaction. But basically, you're just saying you can go directly from Mexican peso into Brazilian real without even having any of this
touching the dollar. Yeah. And now we're not done yet, but this is the goal, and it's possible. Now there's getting the assets distributed, getting on the chains people are using, like getting liquidity out there, but it is absolutely possible, and it is a better way. And so that's why we think sovereign debt needs to be on chain, because it gives an asset. So step back again. So say we want to create this market on chain, where you can FX into assets and those can be off ramped. Well, there's this demand for people to LP these assets, right? Like, so say we're just talking about the world of stable coins. Well, say you want to go from a Mexican stablecoin, Bitsos, which is MXNB, and you want to go from to let's say Tesoro, to Transferos, BRZ, which is two great companies, right? Well, to facilitate like a huge market for that FX to happen with stablecoins, somebody has to LP those assets. So the question is, do people want to hold pesos or reals on chain, especially when there is the dollar so easily accessible? So my argument is, given that it's as easy to hold the dollar or an emerging market peso or real, people will gravitate towards the more stable asset, which actually isn't the dollar right now, but it still has the brand of being that asset. So we have to compete if we want to create the market for this. We have to create a product that solves the same need of a stablecoin, but is also competitive with the dollar as a store of value. So our products are, so the yield that governments offer is really just the risk adjusted for people to invest in that product, given they could also invest in US treasuries. So the yield is built in. So when you're holding a Tesoro, you're holding a Brazilian denominated product that is comparable to holding the dollar or a US treasury, but it's denominated in a different currency, because not only do you have that principal, but you have the yield built in to compensate for that risk. And so when we see that in DeFi, that these marketplaces need to exist to create better efficiencies for FX and to remove the stablecoin sandwich problem, we think a product has to look like the stable bond, where the risk to compensate you for LPing that is built into the product.
Well, that's super interesting because yeah, like I think it's a great point. Like there's no incentive to hold on to some of these, these, we'll call it like non-USD stable coins, right? When, I mean, this is one of the knock on USD stable coins is like, oh, there's no liquidity for these things. There's no demand for these things. It's like, well, there's demand. I mean, people just don't want to like hold them necessarily. People want to use them. They just don't want to hold them. But like if you're getting like 11% return just for holding this thing, then it becomes a lot more attractive. And it's like, okay, maybe I'll put this I'll provide liquidity for this. So I'm just going to earn 11% plus whatever fees I generate from being a part of this, providing the liquidity, right?
And that's also the beauty of the stable bond is, a lot of people, they decide, hey, I want to invest in LTNs or the the collateral for Tesoro because they think it's a good idea. But as a tokenized representation of it, you're also able to squeeze out more yield by having it be some utility on chain, right? So if I was going to invest, 100 million into LTNs, I might as well tokenize it, put it in a marketplace on chain, have that securely my asset, but also earn fees from transactions or lending too, and those demands are there. So, if I want to, and let's just take the dumbest use case ever for FX is an AMM, which is supply curve driven. If I want to compete with TradFi in fees, I could get to a spread that's 5 bips. That is very competitive for the normal person. It's way better. Well, in an AMM, its fee equals trade size by depth. So what that means is if I want a trade size of 10,000 or less, and I have a depth of 2 million, my fee is 5 bips. So what I mean to say is if I want a competitive spread or a better use case on chain, I at least need 2 million US dollars worth of depth in that asset. And so to convince your average person to hold 2 million US dollars worth of real, it's kind of a lift, given that you have access to the dollar. But $2 million worth of LTNs is not that big of a lift because it's the risk is adjusted by the yield.
No, I love that. Yeah, and thank you for that explanation. That makes it. I think that makes it much more clear. And so that's really kind of like the missing link with some of these. Just kind of reiterate. I think what we were talking about, like a product like this is kind of the missing link between making some of these kind of non-USD stable coins like viable products, right? Where it's like you can, like there is enough liquid, like there's using these stable bonds, you can create. There's enough incentive for people to provide liquidity for these types of products that makes them actually look viable, and you can get respectable spreads on them, and therefore people will actually, there's a reason to use them, right?
And I don't want to sound like a bad crypto community member, but we think most people are wrong. Like I like stable coins, I think they're useful, but I think for emerging markets or everyone else, you need a competing product. And I think a stable coin from an emerging market is not the competing product. I think the stable bond is. It's as safe. However, the risk is built in, and it compensates people for not holding the dollar by increasing in value at that rate. And that's just how bonds work. For like higher yield bonds are generally riskier compared to holding the dollar.
Well, I will give you credit. Like I feel like your whole story is very contrarian, and you seem to be right more often than not. So maybe I'm going to give you the benefit of the doubt on this. Like this is pretty compelling.
I'm getting a little tired of it though. Yeah, my next startup, it will definitely be like tax software or something. I don't know.
Something bland and platonic,
just
and
easy,
non-controversial, right? I mean, I'd be interested. I have a couple other questions here just to round out, but I'd be interested in learning more about just maybe like what the reception from kind of the crypto native community is. And I mean, I'm assuming those are kind of the, when you're thinking about just like go to market, who are the first people going to be buying these things? It's like, well, like, hey, you can, if you can earn 11% investing in this token, buying $100 worth of this tokenized Mexican bond, like that's a pretty nice, for 11%, by crypto standards, that's like pretty respectable yield nowadays. I mean, we're not in the, it depends how far up the risk curve you want to go, but like, like in the, the 10, 15% range, that's pretty solid by crypto standards nowadays. So I'd be interested to hear like what maybe the reception has been from, folks in some of these decentralized exchanges like DeFi protocols that have been, integrating these products.
Until Milel had that, meme coin blow up. Do you remember that? And our Argentine president, am I saying his name right?
Yeah, Milei, yeah.
Millet, sorry. I would say it was absolutely horrible for us. It was impossible for us to make. It was so hard. People didn't see the vision. That was an inflection point where all of a sudden people understood what we were trying to do. And you start to see like Vitalik has just said, hey, we need safe DeFi. We need other real world use cases. So I'd say until about a year ago, it was just all fighting uphill because we were fighting against 1,000x return expectations. You know what I mean? And we're saying, hey, we have 15%. People are like, that's stupid, even though the real return for those 1,000x returns is zero. I think now we are getting people, we're getting countries coming to us, we're getting institutions coming to us, and now we're getting blockchains coming to us, where before we were having to bang down people's doors to get them to see our vision. So I think people are finally starting to see, and the headwinds are behind us now. It's really nice now. This is the best it's ever been. But in the early days, no one really understood what we were trying to do, and no one believed that anything but the dollar was even necessary. Now that people are saying, "Hey, we need FX," and now that like a lot of these huge companies fundraising for FX, like they're not, I mean, again, I don't want to be a bad community member, but they're not even FX. They're just changing the country in which you gauge FX in, from the United States to Brazil. Now all these like startups are like, we're in Brazil, we understand how to do FX here. Well, because I can send USDT from the US to Brazil for free, now that company has the FX engagement. Before, you would do it in the United States, and the institution would interact with the counterparty in Brazil. But now we've moved that place that happens. So we give people these tools, and these blockchains these tools to do real world things, and people are finally starting to see that. So the biggest onboarding we're having now is we're onboarding foundations. Like foundations are coming to us and saying, we want your assets on our chain to do these things. And so we're saying, let's do it. The primary mechanism is, we need liquidity for lending markets to work. We need liquidity for AMMs to work. So how can we build that together? So that's really like the place we're deploying the most. And now people don't necessarily need to come to us. If you opened your wallet, I don't know what's your primary chain. And maybe you don't want to say that, but let's hypothetically say you worked on Solana or Stellar. You could open up either Freighter, which is Stellar, or Phantom, and you could just search Etherfuse, and you'd be able to buy our assets directly on chain. And that has nothing to do with me. Someone else has deployed those assets there.
And that's what you guys are trying to ultimately be, right? You're trying to be the SDK that allows people to build it. Like, you don't want to be building these things yourself, but you're like, hey, we have these tokenized bonds, like you can do stuff with them. Like, please come and like create something of value to other people that, whether it's just like a distribution mechanism or like a lending, like, I mean, what other types of, as you've been having to kind of go around, like showing people like what you can, trying to give people ideas, like what can you do these assets? Like, what are some other use cases that you guys have been presenting, or other people have maybe come up with, aside from like stable coins and maybe like, on-chain lending, using these as collateral or something like that? Like, what other use cases have maybe caught on?
So like indexes. So say you wanted to create like an emerging market index, you could create one just using our emerging market assets. So hedging during ascend. So I can, if I want to send like the Real to Dubai and wait for it to off ramp, say it has a 5 to 7 day wait period, I can actually short or long one of those currencies to ensure that at a bare minimum, I have my principal. I might forego some of the yield over the time it takes for that to clear. So hedging is a real use case. No one's really tackled it yet. It's trivial if you know how to code. And probably should start being built into some of these FX providers, but that's one. Another is leveraged investing. So if you want to loop, so the risk appetite of crypto is very high. So if you wanted to loop or Tesoro product with BRZ, so you borrow BRZ. I keep saying Transfero's product because I love those guys. They're awesome. Okay, but say you want to borrow BRZ, and with that BRZ, you can buy our Tesoro product. And then you borrow more with our Tesoro, using our Tesoro position to borrow more BRZ. You can do that 4 or 5 times, and you can get up to like 40% yields. There is some risk, of course, but that's just, you can use these principal building blocks. I would say, FX, we talked about. Savings accounts. So a lot of wallets, they let you send money back and forth, but no one really talks about, hey, why don't we just like do like a TransferWise, or where we have savings accounts. You could totally do that with our assets. So those would be the primary ones. Anything you can do with real sovereign debt, you can do with us.
I mean, it seems like a lot of the focus here is on the emerging markets, right? But with these debts and with these currencies, but like, I mean, even for folks in the U.S., I mean, if you're giving me the option of like, I can just click a button and put $100 into a, like a Brazilian tesouro that's going to pay 15%. Like, I mean, that's like a pretty good sort of fixed income. Like, you don't really, it's hard to find stuff in the US that pays that much with basically no risk, right? I guess, the question would be like what type of interest have you found from maybe like either customers or institutions in the US that are like, hey, we'd be interested in this if it's like super easy to integrate, right?
Yeah, I'll speak around this. We actually directly block US persons from buying
Oh,
from us. But I would say that appetite for US persons to invest in emerging market debt while eliminating a lot of the middlemen is very high. So right now, I'll use Mexico as an example. There are a lot of people in the US who invest in Mexican treasuries, but the only way they can do that is through an ETF in the US, because it's their only, like, without some huge investment of setting up a company, a brokerage account, the only way to do it is through an ETF. Now, the yields in the ETF are 3% lower than the yields you get with our assets. And the reason why is because there's 2 or 3 or 4 people in the middle taking a cut from you and the ETF. So it is just fundamentally better to buy our assets. Now, I think there's still some caution when investing in crypto in today, but to the limit over the next 10 years, I doubt we'll see a lot of direct investment through ETFs anymore. It's just so much better. So the appetite is high. It is nuanced because it's unclear how to do yield bearing assets in the US. So for now, we avoid it.
Sure. Yeah. That makes sense. Right. This is the kind of the lingering, like the hanging Chad, like lingering sort of problem to be resolved with the Genius Act, right? Is the whole yield bearing issue. And then I mean, it's one other question here, kind of on this subject of risk, right? Where like I think a lot of people like people in like bond markets, they're used to these concepts of like sovereign risk and whatnot. And people in crypto are used to these kind of crypto native concepts of risk, like you have smart contract risk and counterparty risk and whatever. And then this is the first product I've seen that kind of like incorporates both of those, right? Where it's like, yeah, like the smart contract might get hacked or Mexico might default on its debt, right? Like these are so I mean, how do you kind of go about maybe like just articulating like what's the risk profile of a product like this, to folks who are maybe like kind of doing due diligence or trying to better understand it?
Yeah, I would say there's 2 risks. There's the country or sovereign risk, like you just said, and contract risk. So sovereign risk, I would almost say most people shouldn't even think about it. It's so low that it's trivial. Unless you're like some complex emerging market investor, sovereigns do default on their debt every now and then. But if you
Well,
looked at
if it's Argentina, you might have a problem. Like, Argentina's kind of has a reputation for defaulting.
Exactly. If you looked at a map over the last 20 years, who's defaulted on debt, like out of every country in the world, there's like 1 or 2 that happens like every 4 years or so. So it's still pretty low, and it's not like you're going to get caught off guard. You generally have a pretty good idea if a country's going to default on their debt. So you should think about it, but I think it's less of a concern. It's very rare. The contract risk, we try to mitigate that through policy. So we have, and I would say there's also like regulatory and trust. So like, are we good stewards of your collateral? So we to help persuade you that we have third-party auditors who continually validate that for every asset we've issued, we have corresponding collateral. They have viewership access in all of our accounts, and we post those attestations continually on our site. So if you go to our sites and you look at reserves, you'll see a history of attestations from a third party. Contract risk, every single one of our commits is validated by a third-party security auditor. So most people, they'll do like a version and they'll go through and get a security audit on it. We do it literally every commit. So every commit, we have someone checking and ensuring, and you can see those on our website. Contract risk on chain, that's a tough one because there's not a lot we can do, like what Solana or Stellar does, but some are less risky in the sense that on Stellar, it is up to the issuer to determine if they want to do things like be able to be a freeze authority or to be able to reclaim assets. And so on Solana, we don't have that, but on Stellar, it is totally possible, giving like a hack for us to freeze those assets, to call somebody, to get legal permission to reclaim those if it's possible. And some people think that's a good thing, and some people think it's a bad. If you don't like the fact that we could do that on Stellar, maybe you want to work with Base or Solana or something like that. But we give those options for you to pick your path, and they are concerned, but they're pretty low still. Considering you're already in this space too. I think you're asking the question from a perspective of someone in TradFi. If you're in crypto already, there's no additive risk.
You've created this product that really is, it fuses together. I mean, I guess your name of your company is Etherfuse. I feel like you're really fusing together, like, kind of the best parts of the kind of the blockchain data finance world, and the best, and the bond market is really like the backbone of any, of any economy, right? Of any national economy. So, like, I mean, given that we're just kind of in the beginning stages here, but you guys have already seen some product market fit. You're already seeing some experimentation with like new types of things that can be built once you have this debt on chain. I mean, how do you see these types of products ultimately like fitting in, into the financial systems in these countries and even globally, over the next, I don't know, like 5 years or so? Like, how is this going to kind of fundamentally, I mean, if this works like as it could, like, how does this kind of like just fundamentally rethink like how are we thinking of bond markets?
I think that this is a primitive for anything you want to do in that country. We look at this as like, what's, people always go, what's missing with crypto? Why isn't it like, what else needs to happen? We view this as it. If you look back in history, like, why did the Europe grow faster than other places? And you look at like when they tried to start nations with just a currency, they generally failed, because a currency isn't a sophisticated starting point to build a financial economy. And so some examples would be like Pancho Villa in Mexico, or Alexander the Great, where they just issued a coin. But if you look at back some of the successful nations, they started with a bond, like Venice or Amsterdam or France. They started with these like Prasiti or these, and the bonds helps build a product with a revenue stream in it that is dependable. So we view this as like the missing component. So for non-US entities to be successful, they need to bridge their currency to debt and build products on top of debt. So extrapolated over 5 to 10 years, we view ourselves as being essentially the AWS for this primitive, for debt on chain. And with that, people will build everything else that needs to exist to bring TradFi on chain. So if you want to on-ramp Brazil, you need to on-ramp that Stablebond. And through that, you can build other products that are competitive with other things in the rest of the world.
No, I love that. Well, David, really appreciate your time, and this is super interesting being able to dive into this. And yeah, I love what you're doing. I love the contrarian sort of it seems like your whole career in crypto has been like against the grain. But,
I'm tired of it, dude. I just want to hang out with everybody in the future.
but like it feels like you're like hovering over the target here, which is super interesting, and it's great to see that you've gotten some meaningful. Shout out to our good friend Javier Milei in Argentina for
yes, thank you, sir.
for instigating some people to rethink their investment strategies and whatnot, and to take more interest in this type of product. But maybe just to wrap up, how can folks find you or learn more if they want to get in touch?
Yeah, app.etherfuse.com is our actual app. Etherfuse.link. I'd say the best way to contact us now is through our new Discord. We do have a Telegram. I'm at Etherfuse on Telegram. That's how to get directly to me. But Discord's also monitored by people. So reach out to us. We want to onboard you, and especially if you're building products, we want to help you build them, and we think we can eliminate a lot of work for you.
Yeah, well, thanks again, David. Really appreciate your time. Thanks everyone for watching. We will see you next time on Brazil Crypto Report.